This is the most comprehensive guide to help you understand what a co-op is, how it operates, what to expect when buying an apartment in a co-op building, and the requirements for co-op ownership. This video has a lot of important information, so let's get right into it. You've probably heard the term condo before, which seems to be the same concept. You own an apartment you own an apartment in a multi-unit building and you share all the common areas with other residents. Both condos and co-ops can be large buildings with a few hundred units, and both of them can be small buildings with less than 5 units. The difference is not the size or the aesthetics of the building, the difference is the type of ownership. Suppose you've purchased a condominium apartment. This means you own real property. You receive a deed and you hold a title to your property, just like buying a house or a land anywhere in the country. Also, because your purchase is within a condominium association, you own a percentage of the common elements in the building as well, such as the lobby, hallways, elevators, and so on. I have a detailed video on condos, which I'll link in the description of this video, but for now, this overview should be enough information about condos. Now, let's talk about what you actually own in a co-op building. When you buy an apartment in a co-op building, you are buying in a cooperative corporation. The corporation owns the entire building. In this case, the real property is the entire building, not your apartment. Inside this building, each apartment is allocated a specific number of shares. For example, apartment 3A has 425 shares. Similar to the concept of shares in a traditional stock market, shares represent a portion of the stock in a corporation. When you buy shares, say in a company called Pineapple, you become a shareholder of Pineapple. Now you own a piece of that company, and it's the beginning of your shareholder era. So for co-op purchase, you go online, you find a beautiful co-op apartment that checks off all the boxes, and you decide to buy it. What actually is happening? You're not buying the physical apartment itself. When you complete the purchase, that means you bought the shares that are allocated to that specific apartment. Congratulations! You are now a shareholder in that co-op. Unlike buying a condo or a house where you'd receive a deed and a title, here you'll get a piece of paper called a stock certificate. This certificate serves as evidence of your ownership in that building. It looks like a pretty simple buying process, right? Not really. This brings up about a million complications. Don't worry, we're going to talk about everything in details. So, the number of shares that are allocated to each apartment usually depends on the size of the apartment. The larger the apartment, the more shares it has in relation to the other units in the building. In some co-ops, other factors like floor height or even apartment position can also influence the share distribution, but mostly the size remains the predominant factor. The share allocation for each apartment was established when the co-op was initially built or when it was converted from a commercial or a rental property to a cooperative. Let's say you bought apartment 3A in 123 Example Street Co-op. As we've talked about it earlier, unlike condos, you didn't buy the actual apartment 3A. You bought, as an example, 425 shares associated with apartment 3A. So you now hold a stock certificate which proves your ownership of 425 shares in the 123 Example Street Corporation. At this point, you might be wondering, if apartment upstairs 4A has the exact same floor plan and also has 425 shares, can you just decide to live in apartment 4A instead of 3A? And the answer is no. The reason you can't just pick any apartment that has 425 shares and switch is due to something called a proprietary lease. This document specifies that you are entitled to occupy apartment 3A and not any other unit in the building. It's an agreement between you as a tenant shareholder and the corporation which acts as your landlord, according to which the co-op allows you to occupy your specific apartment, in this case 3A, in perpetuity as long as you continue owning those shares. This proprietary lease is an important document that governs the relationship between you and the co-op. So in co-ops, instead of a deed and a title, you'll get a stock certificate and a proprietary lease. Now let's understand how the co-ops operate. Unlike traditional business corporations that typically focus on maximizing shareholder profits, the goal of housing corporations is not to make money for its shareholders. The goal is to provide homes for shareholders. A co-op is run by a board of directors. The members of the board are also shareholders just like you. They need to make sure that the co-op is well maintained and operates smoothly. Depending on how big the building is, typically a co-op board includes roles such as a president, vice president, secretary, and a treasurer. One unique aspect of buying in a co-op building is the board approval process. Because every co-op is different, the board approval process varies widely from one co-op to another. Some are laid back, while others have stringent requirements for buyers. The requirements include a minimum down payment, debt-to-income ratio, post-closing reserves, and a few other things that we will talk about later in the video. The bottom line is every co-op has its own purchasing requirements, and the board of directors have the authority to reject the buyers. So in order for you to complete the purchase, you'll need to be approved by the board of directors. That's exactly why working with an experienced real estate agent is crucial. They'll know how to navigate the co-op buying process, help you avoid buildings where you might not meet the requirements, and manage any complications during this process to keep your purchase on track. So having a pro agent by your side isn't just helpful, it's essential to make sure everything goes as smoothly as possible. Speaking of a pro agent, there is a link in the description of this video where you can schedule your one-on-one call with me if you're looking to buy, sell, or rent here in New York City, or if you just have any questions about New York City real estate. Another important thing to understand about co-ops are the monthly costs you will be responsible for besides your mortgage payments. Remember, co-op apartments are not considered real property, which means you won't have a separate property tax bill for your apartment. Instead, you'll make a single monthly payment known as maintenance. This covers a variety of expenses, including the upkeep and operation of the building, all the common areas, and amenities. Depending on how big your building is, you might have a lot of expensive amenities to maintain. Your monthly maintenance also pays the staff salaries, your doorman, porter, super, and potentially a management company. Larger buildings often employ a dedicated management company and have many staff members that will need to get paid. On the other hand, smaller buildings might choose to be self-managed and employ only one part-time super to keep the costs down. Utilities like water, sewer, and garbage collection, and for some buildings also heat and gas, are typically included in your monthly maintenance fee. Electricity most of the time is paid separately by each shareholder to the utility provider company, although some co-ops in the city include all utilities in the maintenance fee. A lot of co-ops also have underlying mortgage, which means the debt service on the building's mortgage is also included in the monthly maintenance. Don't get confused here. The underlying mortgage is not your personal mortgage used to purchase the apartment. That mortgage you pay directly to your lender. The underlying mortgage is a loan taken out by the co-op itself to finance the purchase of the land or the building it occupies, and it's paid by all shareholders collectively. The monthly maintenance payments also cover your portion of the real estate taxes for the entire building. Co-ops get one property tax bill, and every shareholder pays the taxes based on the shares they own. Some portion of the monthly maintenance can also go towards contributing to the building's reserve funds. Buildings need to keep reserve funds for any emergency repairs. If something breaks down unexpectedly, the building should have money to repair it. Each year, the board, with the help of the management company, create a projected budget for the building's expenses. That amount is divided by the total number of shares the co-op has, and each shareholder pays their portion of the maintenance based on the number of shares allocated to their apartment. Let's go back to our 123 Example Street co-op. This is going to be a very simple example. Imagine the board had a meeting and set a projected annual budget of $500,000 for the building. Now, assuming as an example, the co-op has a total of 10,000 shares, the maintenance would be $50 per share. Your apartment has 425 shares, therefore your portion of the maintenance as a shareholder would be $21,250 for that year. This equals to $1,770.83 per month. This is how maintenance fees are calculated for each shareholder, ensuring that the total collected matches the building's budget of $500,000 $100,000 for the year. It was an extremely oversimplified example, but this will give you a good understanding of how the maintenance works. Some buildings might have an additional source of income. This could be, for example, a commercial space that belongs to the co-op and generates a rental income, or an income from the parking garage, laundry room, etc. If the building has any other source of income, depending on how much revenue the co-op is able to generate from other sources, the monthly maintenance for the shareholders can be reduced significantly. Now let's talk about some of the co-op rules and requirements. The important thing to note here is there is no one-size-fits-all approach when it comes to co-op rules and requirements. What might be considered as a drawback for one person could actually be a benefit to another. It all depends on your specific situation, the reasons for the purchase, your timeline, your goals, and so on. Here are some common co-op purchasing requirements. Number 1, financing requirement. Co-ops have limits on maximum percentage you are allowed to finance in the building. The common down payment requirement is generally 20% across the city. Some buildings might allow as little as 10% down payment, and others might require 25, 30, 40, or even 50% or more minimum down payment. Co-ops also have DTI requirement, which is your debt to income ratio. This is a percentage representing your total monthly debts, including your future housing payments, in relation to your income. For example, if you earn $10,000 per month income as a W-2 employee and all your debts, including your future housing payments, are $2,500, this means that your DTI is 25%. I said W-2 employee because if you're on a payroll, your qualifying income is usually your gross salary. For business owners, freelancers, and contractors, it's a little bit different. This would be a topic for another video, but you can contact me using the link in the description of this video and we'll talk about it if that's your situation. Banks also have DTI requirements, but unlike condo or a townhouse purchase, where if the seller accepts your offer with whatever down payment you're planning to put and the bank approves your mortgage, no one really can stop you from completing your purchase as long as your loan gets funded. But with co-ops, the board has the right to reject your purchase if, for example, they find your DTI unacceptable, even if there are multiple banks ready to lend you the money. Condos have what's called a right of first refusal. Some condos can require as much paperwork as a typical co-op would like to see, but the main difference is the fact that you're not waiting for your approval or rejection from the condo board. You're waiting for the board to waive its right of first refusal, which is completely different than waiting for the co-op to approve your purchase and having a risk of a board rejection when going through a co-op buying process. The same way works for the post-closing reserves requirement. This requirement ensures that you have sufficient funds after completing the purchase. Co-ops usually don't like when the buyers try to spend all the money they have without leaving any reserves. I've seen some co-ops that officially specify in writing what the buyer's DTI and post-closing reserve should be, but most of the co-ops don't. Your experienced real estate agent should be a good resource for you who can help you navigate the specific financial expectations for co-op buildings. Okay, so let's move on and talk about some other co-op purchase requirements. Co-purchasing. This is an option for buyers who may not qualify independently due to financial limitations, such as insufficient income or not enough down payment funds. If that's the case, co-purchasing is when the buyer will try to purchase with the help of their parents or any other family member. Those people are the co-purchasers who usually don't reside in the unit. They are considered non-resident owners. With any other type of property, you can buy with whoever you want. But with co-ops, if you don't qualify to buy yourself and need someone's help, the building must allow co-purchase in order for you to buy in that building. Some co-ops might say no co-purchase, which means the buyer must qualify to buy and carry the apartment without anyone's help. Next one is gifting. Co-ops can also restrict gifted money. Some buyers receive financial gifts to help cover the down payment or even the entire purchase price. If the co-op allows gifting, that's fine. But co-ops can also say gifts are not allowed and require that buyers exclusively use their own funds for down payment or the entire purchase price if it's an all-cash purchase. Co-ops might allow or not allow buyers to have a guarantor, typically parents or other relatives who guarantee to cover the costs if the buyer fails to do so. This is different from co-purchasing since guarantors do not own any part of the property. They might allow or not allow parents buying, which is also different from co-purchase. In parents buying scenario, the parents own the shares and cover all the carrying costs, while their child lives in the apartment without holding any ownership. Again, in any other type of property, this is not a problem. Parents can buy and have their child live there. But with co-ops, this scenario must be allowed, otherwise your purchase most likely will be rejected. The next thing is called a pied-à-terre. This French term refers to a part-time residence. Co-ops can allow or not allow pied-à-terre purchases. Some people come to New York City frequently, they don't want to stay in hotels and prefer to buy a home for part-time use. So if that's you, you need to buy in a co-op that allows pied-à-terre. Every co-op also has a sublet policy, which is crucial to understand before you complete the purchase. Because if you decide to rent out your apartment, you'll need to follow the building sublet rules. Co-ops may restrict the duration you're allowed to sublet your unit. For example, they might allow you to sublet your unit for 2 out of every 5 years or some other variation of that. Maybe 2 out of every 4 years or 3 every 5 years. You get the idea. Another sublet policy type can be maximum number of years. For example, maximum of 3 years total during the period of your ownership. It can also be with or without any initial required occupancy period. There are co-ops that don't allow subletting at all, which means if you decide not to live there, your options are either to sell the apartment or leave it vacant. On the other hand, there are co-ops that allow unlimited subletting, allowing you to use your apartment as a rental for as many years as you want. Some co-ops may allow the shareholders to sublet, but on a case-by-case basis. Usually they would want to know why you're planning to sublet, how long you're planning to sublet, and whether or not you're planning to come back and live in your apartment. Some buildings can have exceptions to the sublet rules. Here are a couple of examples of sublet policies that have a case-by-case language or allow exceptions. Sublets are not permitted except for hardship and are subject to review and approval of the board of directors, and then for only 1-year term. Here's another one. Any further subleases beyond this are at the express discretion of the board and must not be assumed. Again, it's important to note that the right co-op for you depends on your specific needs and circumstances. A building with an unlimited sublet policy isn't necessarily better than the one with restrictions. In fact, for some buyers, co-ops that don't allow subletting might be more appealing. That's it for today's video. Hopefully, this video was helpful for you to understand co-ops, their requirements, and how they operate. Of course, there's a lot more to know about co-ops, which we'll talk about in another video or during our Zoom call. Don't forget to use the link in the description of this video and schedule a one-on-one call with me if you're looking to buy, sell, or rent here in New York City, or if you just have any questions about New York City real estate. Now that you know what a co-op is, the next crucial step is to get familiar with the closing costs for buyers in New York City. Besides your down payment, you need to properly budget for your closing costs. Here's a video where we break down all the costs that you can expect to pay as a buyer in New York City. Click the video and I'll see you there. Thanks for watching.